Okay, great. Good afternoon, everyone, and welcome to the ACEC Research Institute's Future of Engineering Roundtable series. In today's session, the State of the Engineering Economy, Q1 2025. Before we get started, I just have a few housekeeping announcements. For the easiest view, move your mouse to the top of your screen and select Gallery View. This will allow you to see all panelists. Your microphone was muted upon entry, but if you wish to ask a question or offer a comment, please feel free to type it into the Q&A box at the bottom of your screen. We will do our best to answer as many questions as time permits. This event is open to the media, and the press is invited to participate, as with our other attendees, by asking a question through the Q&A box. We are also recording today's event for future viewing. If you require any technical assistance, please feel free to send a message to ACEC Research Institute privately through the chat box, the Q&A box, and I will be happy to assist you. Now, allow me to introduce the Executive Director of the ACEC Research Institute, Daphne Bryant, who would like to say a few words. Daphne?
Thank you, Carrie. Good afternoon or good morning, depending where you are today. Welcome. We are excited to share with you Q1. We were just saying it's hard to believe we're already toward the end of the first quarter of 2025. And we're looking forward to sharing with you the results of the engineering business sentiment. So I have with us today Joe Bates, who is our senior research consultant and author of this study. And thank you, Joe, for being here. And also Thomas Grogan, who is the senior director of economics and market intelligence at ACEC. And Thomas has a lot of great macroeconomic data to share with us to kind of weave into the story of what we're seeing from the sentiment. We had a really strong response rate this quarter to the sentiment, so we're excited about that as well. But I know you guys have a lot to share, so I am going to turn it over to you, Joe, to get us started.
Great. Thanks, Daphne, and thank you for everybody that's here today. We do have a lot of folks on the line today watching our webinar, so very excited to share the information we have. And it's always a pleasure to be here with Thomas. Thomas, welcome.
Yes, great to be here.
All right, so we have three areas that we always like to talk about. The first is, how is the U.S. economy doing? Take a big picture look at what is happening around us. Then how is our industry doing? And then what does the future hold? So with that, we'll get started and jump right into how is the U.S. economy doing. I think that's something that everybody is very, very interested in right now. Things are changing, and we have historically, since the recovery after the pandemic, we have had very, very strong GDP growth. And typically, GDP growth has been revised upward. There's three readings. There's the advanced estimate, there's the second, and then there's the third and final. And what we have seen for the last couple years or so is that once the GDP advanced reading comes out, we often, not always, but oftentimes see an upward revision once the second and or third estimate come out. In the fourth quarter GDP, the second estimate was just released about a week ago, and there was no change. It held firm at its original advanced estimate of plus 2.3%. That's an annualized growth rate. And it is a little bit weaker than what we saw in Q2 and Q3. And if you recall, when the advanced estimate came out, it was well below expectations at that time. So this is one of the first indicators that we have that things may be softening a little bit in the overall economy. It's still a very solid reading of 2.3%, but again, below expectations, and it's, the first indicator we had that maybe things are slowing or softening just a little bit. Now, when we look at jobs, that's another really important indicator of the health of the U.S. economy. And what we're seeing overall, there's a lot of variation here that you can see. In the blue, that's the monthly job creation. And we're positive in every month. You can see last summer we had some much weaker readings than typical, but we had a lot of hurricanes, we had some natural disasters, we had some strikes, and that definitely affected those numbers. And so then you saw some pretty strong numbers in November and December, and then a more modest typical average reading, if you will, in January of 2025. So it's kind of hard to see what's happening with the job situation unless you pull back just a little further. And so if you look at all of 2023, which we don't have on here, we created on average, um, sorry, trying to scroll to my numbers here on the side here, but we had an average of around 232,000 jobs per month in 2023. And that was about 2.8 million jobs in total for 2023. In 2024, it was 2 million jobs, which is very good still, but the average, if you average all those months out, was 170,000. So we're definitely moderating on the job front, and it is still strong. And you see that unemployment ticked up just slightly in the middle of last summer, but it's been sort of edging down again since then. And full employment is considered at 5%. We have not seen a 5% unemployment reading in quite some time. So on the job front, we're also doing very well. It's moderating a bit overall, but still strong. So that is also good news. And then, Thomas, what are you seeing here when we look and drill down into our sector a little bit further?
Yeah, I mean, we'll talk about it in a bit, but the AE industry finished the year pretty well in terms of adding number of jobs. So I think that, this unemployment rate ticking up a little bit is more just a factor of how it's calculated with your numerator and denominator. And, at the start of this year, AE employment is at all-time highs. So I think it's just getting, I would not pay too much attention to this slight tick up in the unemployment rate. It's obviously a very, very, very tight labor market.
Yeah, and what we see when we drill down into the occupational areas of the BLS data, we look at the professional and related occupations. That's where our industry sits, is within that. And we have seen this number that you see circled 2%, anywhere between 2% and 3%. So it's generally been, one half or between half and 75% of the overall unemployment rate. So very, very low unemployment rate within our own industry. And as you said, Thomas, we'll talk more about the jobs in just a little bit, but it's clearly pointing to a very tight labor market. And it would not necessarily be a bad thing at all if we saw that labor market slow down a little bit and ease up, and it may help with hiring engineers as well as other individuals at your firms. Now, another piece of data that just came in last week, it came out on Friday, was the consumer spending data. And we did see January's consumer spending decline for the first time in a long time. Obviously during the pandemic, but before the pandemic, we had not seen any monthly declines in quite a long time. So this is another one of those data points that we're starting to say, okay, it's a sort of a yellow flag. Are we starting to see a slowdown? And consumer spending is responsible for roughly 70% of our economic growth or contribution. So if you see consumer spending start to slow, that's when we start to think, okay, what is there something happening here? But again, it's 1 month, and we know that we had a very strong December as well. It's possible that people were making purchases in December in advance of January, and the slowed down in January just a little bit when there was some pullback. So again, it's just one data point, but it bears watching. We need to really keep an eye out and see what happens in February and especially March. If we get several months of negative consumer spending, that is definitely not going to be a good sign for the overall economy. The other thing that I like to look at here is the Federal Reserve's preferred inflation gauge, which is not the CPI, which we'll talk about in a minute, but it's the PCE price index. And so what the Federal Reserve is trying to do is, of course, is to get that inflation rate down to their target 2%. And right now, the January rate was at 2.5%. On the PCE price index. The core rate, meaning you strip out food and energy, which tend to be more volatile, is at 2.6. And it's been going up actually since August and September of last year when it hit 2.1% in September. So we're actually seeing a little bit of a resurgence in the inflation numbers, certainly not up at 9% or anything like that at the moment, but it's we're not at the target of what the Federal Reserve would like. And so that's another yellow caution. Okay, what's going to happen? And when we get to the CPI, I'm going to ask Thomas his opinion on what he thinks is going to happen with the interest rates this year. But before we get to that, I also like to show where we are with the labor force participation rate. We are still below pre-pandemic levels. And this this is the percentage of all individuals who are working age who are actually in the labor market. So you see that there's been a decline ever since 2009. Part of that is a historical long-term decline due to more baby boomers retiring, and we're getting towards the end of the baby boomer retirement phase. But we have not recovered to that level that we had somewhat evened out at prior to the pandemic. And while it's a very small percentage, we're talking about roughly 160, 170 million individuals in the labor market. So when you talk about these percentages, even if it's a 0.7%, that's a million plus workers that would otherwise have normally been in the labor market that just have not returned after the pandemic. So that just contributes to the labor shortage. I would really, really love to see that participation rate increase, but it just doesn't look like it's going to anytime soon. All right, so a lot of call outs here on our CPI. This is the Consumer Price Index. We hit that high of 9.1% back in June of 2022. And then we saw the low in September of 2024, last year, at 2.4%. But since then, it's been inching back up again, similar to the PCE price index. So we're starting to see not just that, okay, we had stubborn inflation. This is not quite getting down to that 2%, but it may be starting to increase again. And so that is a big deal because obviously the Federal Reserve wanted to start cutting rates this year. And now there's the question of, will they cut rates at all? Will they increase rates? Thomas, what's your call on this?
Yeah, I mean, I think if they were to do any rate cuts, it might be one, and it might be much later on in the year. I think looking at this, going back to June of 2023, when it kind of bottomed out, we haven't made that much progress on this. And, the labor market is still very strong. We still have positive GDP. So there's no reason why they would cut rates right now, and things can, move further before they really take action on that.
Yeah, and there's a lot of other things that are sort of interjecting uncertainty into the equation right now, right? We have today the tariffs have taken effect on Mexico and Canada, and an additional 10% on Chinese goods. They have announced retaliatory tariffs on US goods. And this is something that could be a considerable problem in the short term because it absolutely would lead to higher prices being passed on to consumers. So that it could, in one way, it could add to inflation, but it could also stall GDP growth. And we could, and I stress could, have more of a stagflation situation. So, but we also know that when the current administration announced these tariffs were going to go into effect in February, within 24 to 48 hours, they were pulled back again. So what I think is it's saying to me is there's just a lot of uncertainty. And one, stock market investors don't like uncertainty, business leaders don't like uncertainty. And I think that's where we have to sort of raise that other caution flag is okay, some data isn't necessarily where we want it to be, and we're just not sure what's going to happen with things in this current administration.
Yeah, I mean, I will say the stock market is not economic growth or economic performance. So those are two things to keep in mind. I'll also say I was at a talk earlier today with a woman who worked for the Fed Reserve, and she actually felt, one, I see there's a question about what impact will tariffs have on inflation. Fact is, there's like over 1,000 different categories of items that are getting imported, and everything is going to vary. So to really give a number is, kind of hard at this point, because cars will be taxed differently than energy, depending on who the trading partner is. Some countries are not going to have to pay tariffs, but a benefit of COVID was that it forced a lot of companies to rethink their supply chains, and they used the big word was diversify it. So it's possible, with this shock to tariffs and importing, firms might be better prepared to absorb these changes in a less volatile way. So, again, these are all more problem is it's just adding more to the uncertainty. So is it going to be bad? Well, no, but it might be good, or who knows? It's just a lot of variance right now.
Yeah, and in general, sort of all things being equal, tariffs would be inflationary in terms of they're going to raise prices. It will cause prices to increase. But again, if it slows down GDP, or people, as you said, there's lots of different variables in the equation.
Yeah.
And we have not had a lot of experience with tariffs in the last couple decades, right? So there are a lot of unknowns there. But it's certainly something that in my book is raising a caution flag.
Mhm.
And I don't necessarily see it as a positive because of all the potential negatives and the clear uncertainty that it interjects into the markets. So we have our first question then from the sentiment survey. This is a question that we've asked since well, not the very beginning, but we've been conducting the sentiment survey now for 3.5 years. And this question has been asked for a very long time. And we are seeing a moderation in the concern regarding inflation from firm executives. What this is showing, for those of you who are new to this webcast, is the net rating. So we ask the question that's down at the bottom of the screen: to what extent do you agree or disagree with the following statement? I am extremely concerned about the impact inflation will have on my firm in the coming year. So we take the percentage of people who say they do feel concerned, subtract the number who don't feel concerned, and we get this net rating. So it shows you the balance of where firm leaders are thinking. We had a high point, and a positive number here is not good. On all our other metrics, a positive is good, but this is the way this question is worded. The high point was a plus 85 back in Q2 of 2022. So that was 3 years ago. That was right before that June reading of 9.1% inflation. And so that was our high watermark. We have been consistently falling with a few ups and downs, but now we're at a plus 33. So definitely less concern than we had seen previously, but there is still concern among many firm leaders when it comes to inflation. So Thomas, you have some additional data on inflation. What is your data showing?
Yeah, I think that we kind of post-COVID accelerated, and then, you could kind of see these structural breaks starting around January 23, and a lot of data series where the rate of growth is slower, but it's still growing. And we could see even here, whether or not we're including the energy and food, which is more volatile or not, we're still seeing prices basically 25% higher, than the end of COVID. And, I don't know if maybe what it is one of these things where, because it's rising at a lower rate and not as fast, people are maybe more used to it. It's been happening for so long, maybe forward-looking forecasts or budgets are taking into account these higher cost increases. So the pain of these increases is not as top of mind or an issue. But, going back to questions and concerns about interest rates and everything, the increase and rise in interest rates is, we'll see this is dampened, but it has not eliminated inflation.
Yeah, and I think the key that I take away from your slide here is what you said. It's 25% more expensive to live, essentially,
Right.
than it was 5 years ago. And
Right.
many people are not making 25% more income than
No.
they were 5 years ago. And I think that's where the rubber really hits the road, right?
Mm.
So, Thomas, are all things going up at the same rate, or have they been going up at the same rate, or are you seeing a divergence of certain things are more expensive and certain things aren't?
Yeah, well, that's a great segue if we look at the impact when we separate goods from services in terms of how people can, basically how people spend their money. We can see the black line here, goods, basically peaks about 2 months after the Fed first started raising interest rates in March of 2022. And essentially, the impact of the higher interest rates on goods, which are physical things that you buy, is it had the intended effect. It's actually technically a little bit cheaper now than in the spring of 2022. However, that's only about 30% of what households spend their money on. The services piece just keeps going up. I mean, it has not really been impacted at all by the rise in interest rates. Looking at all of this in aggregate, I'll say one interesting data point that made it to the press a lot over the past week was the study by Moody's, where you were talking about personal consumption spending. Apparently 50% of all the spending that's happening right now is by the top 10% of household incomes. So that is actually, I mean, we're basically on very shaky ground, because if that top 10% of household incomes start to change how they're spending or are impacted by any of these policies or events that are happening, it's almost like that, like don't break the ice game, where at a certain point one of those things is going to drop and a lot will drop. So things are costs are going up, we're still spending money, but it's not that everybody is spending money. Not everybody has had a 25% increase in their salary over the past 4 years. You're very lucky if you have. And so it's just, again, very, very fragile components underlying our economy right now.
Yeah, I've been surprised that the services piece continues to increase as it has been, and we're not seeing any moderation in that at the moment. So I think that's another one of those yellow flags to be concerned about going forward, and we have to watch that very carefully. There's a lot of price information that the government releases. So there's another one called the Producer Price Index. What are you seeing there, Thomas?
I mean, it's kind of the same story. This is more on our business side, right? Where our black line represents the cost for non-residential construction. And so your steel and your cement and the nails and screws. And essentially, that had a huge spike up right after COVID, but essentially flatlined in around fall of 2022. and essentially is, I think, only up like 0.1% at the beginning of this year compared to fall 2022. So you see the impact of the rising cost of capital on essentially the goods piece of infrastructure. However, our industry service costs continue to go up. Now, they've not gone up at all at the same rate, but at a time when the supply costs basically remained flat, our AE services costs continue to go up. I know this information appears later on from our survey, and it's somewhat in line with also what we'll see with the employment data and our revenues. It's continuing to go up, and so things are about maybe 18% more expensive for an infrastructure project. The engineering design costs are about 18% more expensive now than they were pre-COVID.
Yeah, I think the other point that is important to make is once prices go up, they very rarely actually come back down. We do see some fluctuation in individual goods. Like I know lumber, it did come down after it had gone up so much. But overall, as you point out, that the overall, picture is that those prices remain elevated even if they stop increasing. And so it just has a harder impact on the pocketbook or on project costs. So the one interesting thing that's occurred in the last month, which is a positive, of course, is that the 30-year fixed mortgage rates have fallen. Now, a lot of people have been wondering, well, why? Because typically we see mortgage rates going up and down with the 10-year Treasury note, which tends to be impacted by, in part, Federal Reserve policy, but also by other factors. And so what we're seeing here in the last month is we've actually seen a pretty steep decline of almost about 60 basis points or so. Well, 40 or so in the last month, sorry. And in the last 2 months, 50 basis points in these mortgage rates. And that's good news for home buyers. And home buyers can help to stimulate the economy because when you buy a new home, you typically want to buy a new refrigerator or a new dishwasher or make other home improvements. So this is a little bit of a good piece of news, but in large part, it's because investors are taking money out of the stock market or out of other investment opportunities and putting them into U.S. Treasuries, which are considered safer for the long term. And when more people want to buy those 10-year Treasury notes, it actually causes the yield to go down. And that's what we're seeing here. So in this case, it's certainly good news for a consumer who's trying to buy a home, but it's actually not necessarily a positive indicator that the economy is doing better. In fact, it's saying, uh-oh, hey, we're a little concerned, so we're putting our money in a different place. So we talked a lot. We spent a lot of time about the U.S. economy today. We don't normally talk this much, but it's changing, it's shifting. There's a lot of uncertainty, and so much has happened just in the last month or so. But we are going to now turn to how is our industry doing, and we're going to talk in a moment about sentiment data as well. But Thomas, what are you seeing sort of headline numbers in terms of how the industry is doing?
Yeah, so this is from the U.S. Census's quarterly services survey. This is for data through the end of 2024 Q3. The final 2024 data will be released basically in 6 days. So don't have that yet, but year over year growth is up in the nominal 9.1%. So when we look at some other industry adjacent metrics, it's all kind of in line with 2024 kind of being a record year for spending on infrastructure, right? And so the architecture engineering services piece of infrastructure delivery finished or is on par to finish this year pretty strong. We'll see that in the next slide that we saw. This is on the left hand side. These are both looking at year over year changes in revenues as well as employment. Things, we had that dip during 2020. Things spiked back up a lot during 2022. And towards the middle of 2023, it looked like we were kind of going further downward, but essentially both these were plateaued around 2023 and picked back up in 2024 in terms of our revenue growth, as well as our hiring. I think the hiring piece is pretty good when we see what it was like pre-COVID. And if we extended this back further, that 3% year-over-year growth was a pretty solid, steady state growth rate from, let's say 2014 onward, once our industry recovered from the great financial crisis. So it's not the hiring was not as hot, but we picked back up, and we're gonna, I think, finish around like 3.3% year-over-year growth, which is very strong. And so again, our services and engineering revenue are all part of this total value of construction put in place. 2024 ended the year, I think, like $2.15 trillion for the whole year, up 6.5% compared to 2023. Not as high as 2022, and 2021 was double digit. I think it was like 10.7% and 15%. So we're coming down in terms of the overall growth rate, like not double digit, but 6.5% growth is pretty strong. We see it as somewhat public's growth is a little bit higher than the private side's total growth. We'll see, a lot of that had to do with, say, residential, the impact of mortgage rates on sectors that are going to be more sensitive to cost of capital and land development. The most recent data that came out yesterday is showing that, basically January 2025 is essentially flat at, negative 0.2% month over month. And a lot of other sources from folks looking forward, the consensus is not going to be double-digit growth like it had been over these past few years. Should be growth, but it's also going to vary a lot by sector.
And we'll talk about sectors more in a few minutes. But I think it's interesting that your latest data point is also showing moderating growth. And
right.
Yeah, another theme that is coming out of the data that we have.
Yeah, and moderating, but then also, when we look at this, residential growing 5.9%, essentially reversing the negative 5.9% growth it had in 2023. I think that kind of speaks to the resiliency of this overall market, right? And you could lose a little bit in one category and make up for it in another. But this non-residential growth, declining by more than half, right, at 6.4% compared to the 18.9% growth that happened in 2023. I think that is something to keep an eye on, because a lot of those categories that we'll talk about, I mean, especially from the fiscal policy side of things, are not going to be gangbusters going forward. But that doesn't mean that when you're looking at the aggregate, there isn't room for growth. It's just going to be in different pockets.
I think it's really fascinating what you're showing here. And like you said, you're getting a balancing of things, but it really is very sector specific. And again, we're going to get into that. So what's your data showing when it comes to these sectors?
Yeah, so, we see in kind of top sectors, especially top in terms of growth and their value, manufacturing really standing out, growing at 20%, essentially growing $40 billion more this year than last year. Total spend, $233 billion. I mean, if you were to look at manufacturing over the past 5 years, it went from something like 30 billion to 230 billion. And that's all, primarily a function of the different fiscal programs like the IRA and different loans, or that other secular trend of trying to reshore, get more EV, semiconductor manufacturing here, et cetera. But, I believe last year it grew at like 80%, right? So now it's growing at 20%. It's probably going to grow less next year. I think the things like power and water, which are more, I wouldn't say less volatile, but the longer term trends that we need those sectors, because they really are supporting like populations and stuff, are going to be projected to continue to grow and are, solid chunks of money that we need. Whereas something like the manufacturing is a little bit more variable. Also, this was kind of the first year where we're having more categories see this negative growth. Conservation, lodging, smallish compared to the commercial sector. So commercial, actually, if we were to like rank all the non-residentials in 2023, commercial was the second biggest sector behind manufacturing. 2024, highway and street, power, and one other, I believe, educational, all the spend in those groups was higher than commercial, really for the first time in like 20 something years. Commercial really being impacted by interest rates, as well as these other trends that, maybe were pulled forward or are more prevalent now with respect to what's happened to core downtown urban areas, these shifts in work from home, working remotely, just where people have kind of, readjusted to this new normal. So I think those are things to keep in mind. And there's second call out, and I know we'll talk about data centers. Office, if office only was positive because the census includes data center spend in that category. Similar to what I said to the challenges commercial has, office is facing those as well, and I think those are two sectors where there are the haves and the have-nots. Certain parts of commercial and office and all that do really well, but then a large chunk is not doing well.
And I'm curious, what might happen now that we're seeing the federal workforce being required to return to the office. Will some private employers follow suit? I know that that's been a huge question over the last year, just what's happening there. And our own data the last time we asked the question, we'll probably ask it again in the second quarter, is, what's your firm policy? And among private sector folks and firms within our industry, the average right now, the sort of norm is 3 days in the office with 2 days remote. So I think that's also something to watch. Is that going to have an impact on the office space market? Will that trend reverse or not? But I think this is fascinating data. Now, again, we're still kind of looking up to the present and not yet looking forward, and we'll talk about that in a few minutes as well. But our first big sentiment slide, regarding the U.S. economy, hit an all-time high in the first quarter. Now, it's really important to understand that this survey was conducted. Half of the respondents responded the week before inauguration in January. Half of them responded the week of and after the inauguration day on January 20th. And we looked at the two to see if there was a difference between the two groups, and there was not. So as of that time, this is where our sentiment resides. And it is a huge increase, a 13-point increase in the net rating regarding sentiment on the U.S. economy. And this is a new high. We have not had this level of optimism regarding the U.S. economy. We hit a low point of a -15 in 2022 Q3. So again, back when inflation was soaring and people were very concerned about a recession. The last time we hit a number that was near this was a +40, and that was the very first quarter that we conducted this study back in 2021 of Q4 of that year. So this is a really, really interesting development. I was at a presentation in Kentucky, and I polled the audience. I asked them to raise their hands if they thought that the Q1 number would increase, decrease, or stay the same. And the vast majority thought that it was going to decrease. And so that room, at least of 50 people or so, was definitely not feeling this optimistic. So I think it's kind of interesting to see that, at least as of 5-6 weeks ago, we are as a whole more optimistic about the U.S. economy than we were previously. Now,
Hey,
again,
Joe.
Yes.
I think that is interesting when you think about, as you said, the timing of this, right, was right before and right after inauguration. And certainly a lot happened in that first week, but a whole lot more has happened since then. And to your point, when you polled the audience a week ago, it seems as though if that were our sample, this number would have gone down, right? And we just got a question in the chat of, what do you think the sentiment's going to be after this week's events?
Yeah, so this
In
is
your crystal
something.
ball.
Yeah, this is something we've been talking about internally, and my crystal ball would say, given everything that's developed, I would have to say when we pull firm leaders in Q2, it's going to come down. I don't see that it would get more positive. I have a hard time seeing that it would stay this elevated. So I think I think that we're going to see some moderation in this optimism that we were feeling back in January. Clearly in January, more people were feeling optimistic than not. Things were looking good, but there's been a lot that's happened in 6 weeks. So yeah, my crystal ball would say I'd place a bet on that optimism moderating after this first quarter and into
And
second.
honestly, a lot more could happen in the next 6 weeks, right? So
Yeah, there's just again, there's so
hard to
much
know.
uncertainty. It's really hard for us to say at the moment. We're kind of in a real-time watching mode. Now, what I can tell you is when we look at that US economic sentiment and we break it down, now there's a lot of numbers on this slide for those of you who have not seen this before, but it shows quarterly data of the US sentiment regarding the US economy from firm leaders. And so the top line is the total, and then you'll see it by region as well as firm size. So what I thought was really interesting is that in the Northeast and the Midwest, we saw very modest increases of +5, +3, quarter over quarter, and even year over year. But in the South and in the West, we saw very big increases in the US economic sentiment. So, we do not ask political affiliation. We don't ask anything regarding that at all in this as a business sentiment survey. But we also know that in the South, we see more support for the current administration. And in parts of the West, we also see that. So again, it's hard to know how much of the optimism is because of the appeal of the current administration to some folks. We just don't know for sure. But we definitely need to keep our eye on this. We did see increases across all firm sizes, so that's positive. That's obviously a good thing as well. So, we're not doubting the data that we collected in January at all. It's just so much has happened and it's going to continue to happen. So we just have to be a little bit cautious. When we look at the sector performance on sentiment, it's looking, again, overall, it's very positive. We're at, +80, +50s. These are all very high numbers. The blue circles are the sectors with the highest sentiment. So we see data centers, we see water and wastewater. I mean, a lot of this is very much in line with the actual data that you have, Thomas, from last year. But what we also are seeing is our declines quarter over quarter and year over year in quite a few of these sectors, particularly those that are IIJA focused. So energy and utilities, transportation and airports and roads and bridges and transit. And so we are seeing a softening, but it's all very strong, of course, but a little bit of a softening in these particular sectors when we look at current sentiment. Backlog is very healthy. This is a metric that we've tracked ever since the beginning of our survey over 3.5 years ago. Our median backlog is 11 months right now. It tends to go between 10 and 12 months, just depending on the particular quarter. And so we're at 11 months right now, which is very solid. Smaller firms tend to have shorter backlogs, which is not surprising. Larger firms tend to have longer backlogs. We have that detail in the full report, and we'll show you the QR code to access the full report later in the presentation. But again, all indications are very positive when we're looking at backlog. And when we look at the number of job openings, we have a lot of job openings still. 9 out of 10 firms have open positions. The median number of open positions went from 5 to 6. It actually increased, and that's in almost entirely due to larger firms having more openings in the last quarter than they had for several quarters before that. So on the jobs front, firms are still telling us we can't get enough people to fill the positions. Thomas talked about that earlier. He has another slide in a little bit about that. So very positive news on backlog. We can't get enough workers. So our industry is still doing very, very well right now. And when we look at open positions as a percentage of FTEs, we also see it's been very steady. And last quarter, we were at 8%, which was a slight tick down, back up to 9% this quarter. And again, I point you to the Q1 2025, the more than 500 FTE area, 10%. We have not seen that high of a percentage among large firms before. So we're still seeing very, very strong demand for workers, and that's resulting in very strong wage growth as well, which we'll talk about in a few minutes. So the current landscape looks very solid based on the data we have as of the end of the year, or January sentiment reading. But what's going to happen in the future? I think this is, of course, the billion-dollar question, and we've been trying to address a few of those as we have gone through the slides. But this is just a reminder. Our forecast as of October was that we were going to continue to see moderating growth overall in the industry. Our preliminary read for 2024 was 4.4%. Thomas's data, your data suggests that this might actually be higher. You're seeing 9% year over year, so that may be revised upward. We're currently working on an updated forecast because of all the changes that are occurring, but nonetheless, we're expecting a moderation in spending overall within the industry. Now, when we look at future sentiment, we also saw a huge jump in the condition of the U.S. economy. And again, we see that is in large part due to improved sentiment in the South. This also led to improved sentiment regarding our industry as well as firm finances. Typically, we've seen the economy numbers sort of disconnected from the engineering industry and the firm finances, but the last few quarters, we've seen them moving in tandem. And so that's another new thing that we're watching, but very positive as of January of this year. And again, here's the numbers broken down by region. You'll see that the South increased by 39 points. That was a huge increase in sentiment, and it really helped to push up the overall number. Although we still would have seen an improvement even if you discounted the South in these numbers.
And Joe, just to confirm, I think this is accurate. We haven't seen any change in the participation by region, right? So there's not a huge new participation increase in the South that could be driving this.
No, not at all. Yeah, we ask where your firm is located as well as the firm size, and we track that quarter over quarter, and we have not seen any changes whatsoever in firm location. We've seen a little bit of an increase in firm size in terms of participation, but that has not had any demonstrable effect on the overall numbers.
Thank you. Future
sentiment when it comes to sectors, again, very positive and improving in most of these areas. Again, bucking the trend of the current sentiment reading, we're seeing improved readings for most sectors looking forward. Again, those circles are the areas where the highest future sentiment is occurring: energy and utilities, data centers. And one of the things that a firm leader pointed out to me recently was that there is also this connection between energy and utilities as well as data centers, because we need a lot of energy to power those data centers. So those are somewhat connected. Again, industrial and manufacturing facilities, as you were talking about, Thomas, that's improving. It's improved a lot over the last year. We're continuing to see positive optimism there because, again, I think people are anticipating, more onshoring, continued facilities being created in the U.S. So lots of positive optimism there at the moment. Your data, Thomas, what does this tell us?
Yeah, I mean, this is just from the Association of General Contractors doing an industry sentiment survey. You're basically seeing convergence around a lot of the same sectors, a little bit difference, and maybe the naming conventions, but really meaning the same thing. So, data centers, water, power, followed by transportation, healthcare, manufacturing, those folks are all pretty bullish on those sectors as well. And then we see down at the bottom, what we've talked about, the ones that are going to be more sensitive to these higher interest rates and higher costs of capital, just less positive on going forward. So I think that it's a good sign that others in the industry feel positive about some of the same sectors that our members are feeling positive about.
Yeah. We ask individuals who are not feeling positive what they think, why they are not feeling positive. And again, keep in mind this number is shrinking because fewer people are less pessimistic, or fewer people are pessimistic, more people are optimistic about the future at the moment. But still, we see political environment and uncertainty as number one. And other than the fourth quarter of last year, that had been the main concern among those who had negative future sentiment. We've seen declines, although still fairly high, in general economic uncertainty. We've seen declines in inflation and rising cost concern, declines in recession concerns, a slight decline in workforce shortage concerns. So those are all good numbers. But the one interesting thing here is that we're seeing a spike in concern about what we termed as slow rollout of the IIJA. We've used that wording for a very long time now, but I think from what I'm hearing from firm leaders is that this is more of a concern that are contracts from the government going to be paused? Are they going to be canceled? Are there going to be government workers in the positions to approve the work, to make sure the work is being done? And that is something that is causing a bit of concern to some individuals in our industry. So that, again, is something that's, we need to watch. We need to see how that plays out and see what happens there. And the same with supply chain. I think it's related to that same concern is, okay, are we going to be able to get the goods that we need from outside the US? Are there going to be disruptions because of tariffs? And so there's a little bit of an increase in concern there as well. But again, back on the positive side, we see future backlog sentiment has increased. It had been sort of slowly ticking down a little bit over the last year, but we jumped back up to a plus 41. So people are positive there. When we look at the status of hiring, we see future hiring sentiment has jumped back up again. We saw it kind of moderating over the last year, and then in the first quarter of this year, jumped back up to a plus 71. We're seeing particular strength in the West, which had been softer than the other regions over the last year. Firm sizes, all positives, and particularly among 26 to 50 FTE, a plus 32 there in terms of the increase in hiring. So no let up in demand for hiring. And when we asked about recession concerns back in January, they had gone down compared to the prior quarter. So, again, there's a lot of data here, a lot of interesting numbers. And then there's also caution flags that have come up in the last 5 to 6 weeks that we're going to have to wait and see what happens. We always ask a few hot topic questions at the end of our quarterly surveys, which these are not asked every quarter, but we tend to ask them maybe once a year or so. I'm just going to go over these very quickly so that we have time for any questions. If you do have questions, please ask them now. We're seeing that in terms of wage growth, 9 out of 10 firms, that's not shown on this slide, but 9 out of 10 firms reported increases in salaries for new hires, and the average increase was 9% in January compared to the prior 12 months. And we're seeing this now for the fourth year in a row. So when we talked about wages for the average worker, we were talking about how they weren't keeping up with inflation. But within our industry, we are absolutely seeing wage growth that is more than keeping up with inflation. It's outpacing inflation. And so if you're a worker in our industry, you're doing very, very well. If you're the owner, you're saying, well, how can I control my costs? And the costs keep going up. And you're right. I mean, year after year after year, 9% growth, that's going to really cause a lot of stress on your payroll. So it's certainly something that, we're continuing to monitor. And existing staff increases, again, following the same trend as we've seen in the previous years, 7% year over year. So it does tend to point that if you are trying to search for a better job in a new firm, you might get a slightly bigger increase, but firms are really trying to keep their staff. They're trying to make sure that the staff they have stay, and we see that in these wage numbers as well. When we look at AI strategy, more firms have an AI strategy in place this year than they had a year ago, and fewer firms say that they don't have one at all. But yet 32% say that they don't have an AI strategy and they're not currently working on it. So that's something that we are actually trying to address with our Firm of the Future initiative. Our first project is on artificial intelligence, how the industry is being impacted right now, sort of the history of artificial intelligence, and we really are trying to bring everybody up to speed on what is AI, how are people using it, what can it be used for in the coming years. And so watch for that report to come out at the ACEC conference, spring conference in May. When we look at people's perceptions about AI, whether it will have positive, negative, or have no impact at all, more firm executives feel that AI is going to have a positive impact on their firm in the coming year than said so last year. So that's good news as well. We're seeing that firm leaders are starting to see how can we use AI? Can we make ourselves more productive? Can we do things in a way that will help to alleviate some of the pressure of the worker shortage? And so this is all positive news. All right, so I know I went through those last few slides fairly quickly, but I wanted to leave time for questions. We have a few more minutes. Plus, Thomas, any other comments you wanted to make there?
No, it all sounds good. I will say one thing, I guess, maybe with respect to the optimism in the South. I know that the Dodge Momentum Index has shown that the South is pretty strong for construction starts. So it could just be, things are being built there right now. So folks are pretty optimistic about the future.
That's a good point. Yeah, that I had not seen that number, so that is really interesting.
So I'm not seeing any further questions in the chat.
Okay.
But if you do come up with any, please feel free to contact us and we will get some answers to you. We are going to, the new report is live, so we'll show you that QR code in just a minute, but we do want to thank our donors who make all this research possible, and thank all of you for attending and participating. Please send us any questions you might have. This QR code that's coming up on the screen will get you to the full report. As always, there's a ton more in there than we have time in an hour to cover. So I encourage you to grab that and take a look and then send us any questions that you might have. Thank you all so much for attending. Thomas, Joe, as always, thank you for all your insights. We'll continue to monitor and report as things are constantly changing right now, right? Maybe more so than ever before. So stay tuned, and we'll look forward to seeing you on the next Future of Engineering Roundtable. Have a great day, everyone.
Great. Thank you.
Thanks, everyone.